All right, everyone. So today we are talking about protecting your investments. We're going back to the basics with Benjamin Graham and the intelligent investor.
Back to the basics.
Yeah, we're looking at common stocks specifically through the lens of Chapter 5. And I think it's really fascinating that even though Graham revised this chapter in 1971, he was still pulling from his experiences from the 1929 crash.
Right. I mean, the 71 version is the one that we're looking at today, but it's incredible how those lessons from 1929 were really ingrained. And you can tell how impactful that was for him just in reading through this
Yeah,
chapter.
it really highlights that long-term view because he was writing this decades later,
Hmm.
and he was still like, no, this is really important.
Well, yeah, I mean, in 1949, when the book first came out, people were terrified of stocks.
Oh, yeah.
It took 25 years for the market to recover from that crash.
Wow.
So those memories were still very fresh. And the idea of putting your money into stocks, it seemed incredibly risky.
Oh, absolutely. Especially after you've lived through something like that and seen how it can just wipe out people's savings.
Yeah.
But then on the flip side, by 1971, things are going pretty well. And some people are thinking, okay, the good times are here to stay. So Graham is kind of like, hold on a second.
Yeah, he's waving that red flag already back then.
Yeah.
He's saying, be careful about these high prices. Don't get caught up in the hype.
Right. It's not just about what's hot right now. It's about the fundamentals.
Exactly. And that's what Graham was all about, understanding the value behind an investment, not just chasing the next big thing.
So if we're in that 1949 mindset, and people are still terrified of stocks after the crash, why even bother with them?
Well, Graham actually makes a really compelling argument.
Okay.
He says that common stocks can actually offer better protection against inflation than bonds.
Okay. I've heard that before, but I've never really understood why.
Well, think about it this way. When inflation rises, companies can usually increase their prices to keep pace with those rising costs.
Right. They have to adjust to stay profitable.
Exactly. But when you own a bond, you're stuck with that fixed interest rate.
Oh.
It doesn't matter if inflation goes through the roof.
You're locked in.
You're locked in.
Wow.
And that's where stocks can be advantageous because those companies can adapt and grow their earnings over time.
So it's almost like a built-in protection against that eroding purchasing power.
Precisely. And on top of that, Graham also points out that historically, common stocks have often provided higher returns than bonds over the long run.
Okay, that makes sense. But I feel like I always hear about the exceptions to that rule, where stocks have actually underperformed.
You're absolutely right. And Graham actually addresses that head on. He points out that leading up to 1949, stocks had actually underperformed bonds over the previous 20 years.
Wow, really?
Yeah,
So this just completely flips the script.
it does. And that's why he emphasizes that past performance is not a guarantee of future results.
Right. It's not as simple as just following the crowd.
Exactly.
You really have to think for yourself.
You have to look at the fundamentals and take the long-term view.
So even if you believe in the long-term potential of stocks, Graham is saying don't just blindly jump in.
Right. He's saying be mindful of the price you're paying because buying at inflated prices can wipe out any potential gains.
It's like anything else. If you overpay for something, it's going to be harder to come out ahead, even if it's a great investment in theory.
That's a great way to put it. And that's why he lays out some ground rules for the defensive investor.
Because you want to make sure you're setting yourself up for success from the start.
Absolutely. He says, think about it like assembling a team.
Okay.
You want a mix of strengths to balance each other out.
I'm with you. It's like building an all-star team. You don't want everyone playing the same position.
Exactly.
So how do we apply that to building a portfolio?
Well, Graham gives us 4 key guidelines to follow.
Okay, let's hear.
The first one is diversification.
Makes sense.
Don't put all your eggs in one basket.
Right.
Instead, aim for a portfolio of 10 to 30 different stocks.
10 to 30, that feels like a manageable number.
Exactly, you want to spread your risk. But you also don't want to get so diversified that you can't keep track of everything.
Right, because if you have too many, it's like you're not really paying attention to any of them.
Exactly.
So diversification is key. What's the next rule on the list?
This is where Graham gets really picky about the companies themselves. He says to focus on large, prominent, and conservatively financed companies.
Okay, so not just any company will do. Conservatively financed. What does that even mean?
It means they're not drowning in debt.
Okay, so they're not going out and making risky bets left and right,
Exactly. They're being responsible with their money.
which is a good sign if I'm going to trust them with mine.
Precisely.
So we're talking about those big, stable, blue-chip companies, right?
You got it.
The ones that have been around for decades.
Exactly.
They've weathered the storms.
They have a proven track record.
And they're probably going to be around for a while.
Exactly.
Okay, so diversification, blue-chip companies. What's next?
Look for companies that have a history of paying out dividends consistently.
Okay, so it's not just about their potential to grow, it's also about their willingness to share the profits with investors.
Exactly. Dividends are like getting a little bonus just for being an owner,
I like bonuses.
and it's money that you can either reinvest or use to cover expenses.
It's like getting paid to be patient.
Exactly.
Okay, so we've got diversification, blue chip companies, dividends. What's the fourth and final rule?
This one's a biggie, and it might surprise you.
Okay, I'm intrigued.
It's all about the price tag.
The price.
Graham was adamant about not overpaying for a stock,
Even if it's a company you love.
even if it's a company you love.
Wow, okay.
He says to set a limit, never buy a stock for more than 25 times its average earnings over the past 7 years.
So even if a company meets all the other criteria, I still need to make sure I'm getting a good deal.
Exactly.
No impulse buys.
No impulse buys.
I like it.
It's about being disciplined and rational,
Even when the market is going crazy.
especially when the market is going crazy.
It's like we always say, you can fall in love with a stock, but you don't want to get married to it on the first date.
Exactly. And that leads us right into why Graham was so wary of what were considered growth stocks.
Right, the companies that everyone's expecting to skyrocket in value.
Exactly.
But it seems like Graham thought those rockets could easily turn into shooting stars.
He did. And he wasn't just talking about unheard of startups.
Oh, really?
He actually used IBM and Texas Instruments as examples in the book.
Wow, okay. Those were giants even back then.
Exactly. But even those big names saw their stock prices take a hit. IBM's stock actually dropped by 50%, not once, but twice, within 6-month periods.
Ouch. So even the best companies can hit some turbulence.
Absolutely. And then there's Texas Instruments. Their stock soared for a while. Everyone wanted in on that tech boom.
Right.
But then just as quickly, it crashed back down to earth.
It's a good reminder that just because a company is doing well doesn't mean its stock price is going to keep going up forever.
Exactly. And we've seen this pattern play out again and again throughout history.
Right.
The dot-com bubble was a prime example, and more recently, companies like Microsoft and Cisco have had their ups and downs as well.
So it's like Graham was saying, learn from history, don't get blinded by the hype.
Exactly. Look at the fundamentals. And don't overpay.
Okay, that makes sense. But if we're not chasing those high-flying growth stocks, what's a more Graham-approved strategy for building wealth?
Well, he was a big fan of something called dollar cost averaging.
Okay, I've heard of that, but I'm not sure I fully understand it.
It's pretty simple, actually.
Yeah.
It basically means investing a set amount of money into the market on a regular schedule, regardless of what the market is doing.
So you're not trying to time the market.
Exactly. You're not trying to buy low and sell high.
You're just staying consistent.
Exactly.
It's more about discipline than trying to outsmart Wall Street.
Precisely.
Like it.
And Graham actually cited a study that looked at this approach with the Dow Jones Industrial Average.
Yeah.
They tested investing consistently over any 23-year period, ending as late as 1952.
Wow, so we're talking about some long-term trends here.
And you know what they found?
What?
Every single test period showed a profit within 5 years.
Wow, that's pretty impressive.
It really highlights the power of consistency and patience over trying to time the market.
It's like planting a tree. You don't dig it up every few weeks to see if it's growing faster.
Right.
You plant it, you water it, you nurture it, and you give it time to flourish.
I love that analogy. And Graham realized that not every investor is the same.
Right. We all have different goals, different risk tolerances, different amounts of money to invest.
Exactly. And he actually talks about 3 different investor profiles in this chapter: a widow, a doctor, and a young professional.
Okay, so a pretty diverse group.
And here's the interesting part. He doesn't differentiate them based on how much money they have.
Oh, really?
He differentiates them based on their knowledge, experience, and temperament.
So it's less about the size of your portfolio.
Yeah.
And more about your personality, your risk tolerance,
Yeah.
your individual goals.
Exactly. And his key takeaway is this: it's perfectly fine to start as a defensive investor, even if your ultimate goal is to become more aggressive or enterprising down the line.
So start slow, learn the ropes, and as you gain experience and confidence, you can always adjust your approach.
Absolutely. And, Graham ends the chapter with a really thought-provoking question. He asks, in the world of securities, is there such a thing as a risk-free investment?
That's a good question, because it really makes you stop and think.
It does, because in reality, there's always some level of risk. But as defensive investors, we're aiming to minimize that risk while still giving ourselves the opportunity for growth.
Right, it's about finding that balance.
Exactly.
Well, I think that's a great place to wrap up our deep dive into Chapter 5 of The Intelligent Investor. We've
Yeah.
covered a lot of ground today, from the importance of diversification and finding those blue chip companies, to the power of dollar cost averaging and tuning out the noise.
We even touched on those tempting but sometimes risky growth stocks.
It's all about finding what works for you as an investor, understanding your own risk tolerance, and investing for the long haul.
And remember, successful investing is not about trying to predict the future. It's about understanding value managing risk and staying the course.
Words to live by both on and off Wall Street. A huge thank you to the legend himself, Benjamin Graham, for his enduring insights, and to you, our listeners, for joining us on this journey of financial discovery. Until next time, happy investing.